To say this has been a crazy year for Tesla would be a drastic understatement. With an astonishing 69% price drop since the start of the year, the automaker and its CEO have made this a very painful year for stockholders.
You're watching Trade Daily. Like and subscribe for more daily Tesla stock market news.
In today's video, I'll be breaking down the crazy year ahead for Tesla and be giving my own personal opinion on how someone should prepare for this. Tesla is heading into make or break 2023 with pandemic shine waning. The stock is heading into a reckoning in 2023, and not because of Elon Musk's involvement with Twitter. It's the coming global recession and increasing competition in the market for electric vehicles that will challenge its position. In a worst-case scenario, Tesla shares could see all of their pandemic gains vanish. It's a good thing, for Tesla at least, that Elon Musk got the go-ahead from a recent Twitter poll to step down as CEOs. He is going to need to concentrate all his energy on his electric vehicle maker. This is an important year for the US automaker as it contends both with a potential recession and with a slew of competition in the market for electric vehicles. Like other pandemic darlings, the appeal for the stock has waned now that the era of easy money has ended. It was a bit surprising for most of us as it happened, but the pandemic turned out to be the opposite of a death knell for high-flying asset prices. After an initial swoon in March 2020 as economies shut down, stock markets went from strength to strength, aided by fiscal and monetary largesse. And while the overall market gained, it was what I call the field of dreams companies that rallied the most. Those are the firms who most embody technological promise in our new post-pandemic lives. Think Peloton for those who couldn't use gyms, or Zoom for knowledge workers trapped at home, or even Robinhood for the band of day traders benefiting from it all. Most of these companies have given back all of their hard-won pandemic gains as our work and home lives have normalized and interest rates along with them. Take Peloton, for example. The loss-making exercise bike maker zoomed higher almost immediately after the Fed's March 2020 intervention, reaching an all-time high 5 times the pre-pandemic February 2020 peak. Peloton quickly emerged as a pandemic winner. By May 2020, shares were already at new highs. Zoom had the same parabolic rise as Peloton, though not quite quintupling at its early 2021 high. But like Peloton, shares today are languishing far below February 2020 levels. They too have given back all the pandemic gains. Zoom quadrupled during the pandemic. Shares hardly missed a beat in March 2020. Tesla is different though. It's a more mature company than other pandemic darlings. It operates on a whole different scale. While Zoom is trading at 41 times earnings on expected fiscal year 2023 revenue of $4.4 billion. Tesla is trading at 43 times earnings on an estimated $115 billion in 2023 revenue. The multiple may be similar, but both the expected revenue growth and the scale are much larger. Nonetheless, I would argue the dynamics are very similar. In fact, if you look at the share price, Tesla went higher and topped out later than the smaller pandemic darlings. Trading for at most around $60 a share in February 2020, Tesla peaked with the other megacap tech stocks in November 2021 at over $400 a share. That's well over 6 times. Tesla shares ran up like a pandemic darling. After 2020, it traded more like a megacap tech stock, so Tesla has benefited doubly. In the run-up to the early 2021 post-vaccine peak of high beta shares, it got all of the parabolic gains other pandemic-related stocks did. But it is also now included in the S&P 500. Its entry into the ranks of megacap stocks meant it has traded more like Nvidia or Facebook since early 2021. That allowed it to extend gains for another 9 months and another 30% from that first peak. By the numbers, 58% of 17.5 million votes cast in favor of Elon Musk stepping down as Twitter CEOs. Growth stocks are not the future of this business cycle. The halcyon days of chasing growth stocks are over. The peak was back in November 2021. Here's how I put it at the time. Increasingly, the acronym FANG doesn't describe the large cap technology stocks dominating US indices. I have a new acronym for you, Phantom Man. That's F for Facebook, aka Meta, A for Apple, N for Netflix, T for Tesla, A for Alphabet, aka Google, M for Microsoft, A for Amazon, and N for Nvidia. Over a quarter of the weight of the S&P 500 index is in Phantom Man. And these 8 companies comprise over half of the market waiting for the NASDAQ 100. It may feel like we're back in the 1990s, given the 25.8 P to E on the S&P 500. But even in the 1990s, tech never dominated the way it does today. Not anymore. These stocks have taken an absolute beating. Apple has done the best, and it's had its market cap sliced by over a quarter. Meta has fared the worst, as it was the first to crack. Shares are down by about 3/4 from the high in September 2021. But Tesla is not far behind, having fallen by more than 2/3 in value. But let's remember that Tesla is the only large cap tech stock that went up over 6-fold from its pre-pandemic high and 10 times from its March 2020 low. It has further to fall as a result. The catalysts are threefold: rising interest rates, a recession, and competition. That will, in turn, impact the price/earnings multiple, top-line growth, and margins, putting all aspects of Tesla's valuation under pressure. To date, arguably the loss in Tesla shares has been mostly about the discount rate rising with the Fed's rate hikes, as the P to E has come down to a still aggressive 43. That's certainly superior to the 7x multiple that Ford Motor Co. has on its shares. But Tesla, despite its size, is thought to be in an aggressive growth phase, unlike Ford, a mature company. Even so, with Fed interest rates yet to peak, there is room for this multiple to contract further. At the same time, the Fed's actions could spill over into a generalized recession. That's my base case, along with most other market prognosticators and economists. Recessions are periods of both multiple contraction and top-line revenue stagnation. A few weeks ago, I gave you the example of discounted cash flow models I did when the internet bubble popped. In that stylized example, a business growing 30% a year, less than Tesla. With the expenses fixed enough that 50% of the revenue growth falls to the bottom line, saw a 35% implosion in valuation from mere stagnation. With Tesla, though, we have to add in the margin and growth pressure from the slew of manufacturers coming online now with EVs. There's the Hyundai Ioniq 5 and Kia EV6. We'll be getting updated Audi e-tron S UVs. Mercedes is coming too. All the while, Tesla is being dogged by bad press and declining reliability scores as it scales its business. The result is that Tesla is losing market share, in particular because the under $50,000 electric vehicles are gaining momentum. Meanwhile, in China, Berkshire Hathaway-backed BYD is launching a second EV brand, putting Tesla under even more pressure in that market. Think of Tesla as the AOL of the EV market, a market leader in the nascent phase of the industry's growth, as AOL was 20 years ago as an internet service provider. But once the competition heats up, does it have the mettle to maintain share and margins? Just think about where AOL is today. Now, after all this, it'll give you my personal take on all of this. Comment below what you think. You see, I could go on about the competitive pressures Tesla faces. But let's remember that the last time Elon Musk had a trial by fire a few years back. He came through brilliantly, paving the way for the company's parabolic rise when the pandemic hit. So I want to focus less on that and more on those trials and tribulations as a catalyst for how Tesla trades. What has changed, though, is that Tesla now trades like a mega-cap tech stock. It does not trade at a paltry multiple like an auto stock. It doesn't trade like a pandemic darling either, since all of those companies' shares have crashed irrespective of the actual health of their businesses. In 2023, we'll find out whether the breakout of Tesla into mega-cap land is real, true, and permanent. If so, its losses may be limited because of the moats it has around its business. That's not to say it can't stagnate because of strategic missteps or a collapse in its market's fortunes. Look at Meta and Nvidia, for example. But that's the difference between a loss of 3/4 like Facebook and a loss of all of the pandemic gains like Robinhood, Beyond Meat, or Uber. For Tesla, this distinction could determine whether it trades down to, say, $120 a share or retraces gains all the way down to the $60 price level it stood at in February 2020. Soon, for example, is trading 30% below its February 2020 levels despite doing well financially. That's the power of bubbles popping. So Elon Musk is choosing the exact right time to refocus his talent on Tesla. That's where his own personal fortune was made. Since I started writing this article, shares have lost over 10%. But if Musk gets the strategy right, he will maintain his wealth, perhaps even expand it. Markets are cruel, though. There are very real outcomes which could see Tesla shares, already cut by 2/3, down by another 2/3 before 2023 is out. Both outcomes are equally likely. I've also read other news that would indicate a serious bull run for Tesla in the coming days. I break down this crazy news in this video right here.
Thanks for watching this video, and remember, this is news and entertainment, not investment advice.